Hi, everybody. Thanks for being here. My name is Maria Pearman, and I'm a CPA, a certified public accountant. I'm headquartered in Los Angeles, and I run the food and beverage practice for my public accounting firm. I have a particular expertise in beverage alcohol. I've worked closely in this space with our clients for more than 15 years, and I serve as a contract CFO for those clients. So I'll step in and help them in any sort of strategic financial advisory position. So I'm excited to be here today and talk with you. I'm going to cover some considerations that you should be aware of if you have a foreign brand and you want to expand that into the U.S. I listed some major topics here that you'll want to be aware of as you're setting up an entity to bring your product into market. And just as a point of reference, I am under the assumption that if there's a European brand and they want to bring their brand into the U.S., that you'll be setting up a U.S. entity, subsidiary, to be the hub of all the commercial activity in the U.S. And the parent company would remain in a foreign country. So that's the guise of this discussion. When you're setting up that U.S. entity, you need to make sure that you have the correct entity structure in place, which is something that is not only a tax consideration, but a legal consideration as well. So on these headings, underneath in the parenthesis, I've listed the type of professional you would want to use to help you with these decisions. So with tax, you're going to be working with a CPA, a certified public accountant, to help walk through some of these things, such as what entity type should I choose? And that goes back to the three choices that I mentioned earlier of a C Corp, an S Corp, or a partnership. There are different tax considerations around each of them, different restrictions. So it's important to understand what is best, not only for you in the short term to get that U.S. entity started, but also in the long term when you eventually unwind it, hopefully in the sale of your business. Another CPA function is to help you establish your tax year. Many companies will choose to adhere to a calendar year, which is easy. You do have the option to end your tax year anytime that you want to. So depending on the cycles of your commercial activity, you may choose to have something other than a calendar year end. And then establishing books and records. That's something that a CPA can help with as well. On the legal front, you want to use an attorney who understands beverage alcohol, understands international tax aspects, and also intellectual property. The likelihood of finding that expertise in one person is rare, so most people will work with one attorney firm and then maybe a few different attorneys within the firm, each of whom have their own individual area of expertise. So under this first column of legal, I'm assuming that this is your business attorney. This person should understand contracts, basic business matters, and also the beverage alcohol industry. They're going to help you with entity type selection as well. So where the CPA was looking at it from more of a tax impact, the attorney is looking at it in terms of corporate governance, how flexible your organization structure is. So these two things are equally important, and the CPA and the attorney should be working hand in hand with you to make sure that all of your considerations have been met. Entity creation. So most companies, when you form an entity in the U.S., you need to file for what's called an EIN, and that's a number unique to your business. Your attorney can help you do that. They'll also write your articles of organization and your operating agreement, which is your corporate documents. Intercompany agreements, they can draft as well. I mentioned transfer pricing earlier. That's a very important intercompany agreement and something else that the attorney can help with. And state registration. So if you're doing business in various states, you need to also register with those states. And as an asterisk to that point, there are lots of different things that can deem you to do business in a state. That's a little outside the context of this talk, but just know that the state realm is pretty complex, and when in doubt, register with the state. But you can be deemed to do business if you have employees, property, or sales in that area. IP, intellectual property. So again, assuming that this is a situation where you have a foreign parent and you're setting up a U.S. subsidiary, likely you are going to have a licensing agreement from the parent to the sub, and the sub will then pay the parent for that licensing of the name. So making sure that your intellectual property is protected appropriately. If you have a brand name where there is something very similar in the U.S., you want to make sure that all the appropriate agreements are in place so that those two brands can play nicely together and you know where the lines are drawn. Or if you deem that you do need to go ahead and change your name, it's better to get ahead of that on the front end than trying to figure it out after you're 6 months down the road with commercial operations. And determining the income tax impacts of licensing income. This is where a CPA, again, would circle back with the IP attorney and work to make sure that the agreements put in place from a legal perspective make sense from a tax perspective as well. Finally, I have a bullet point about insurance. When you're working with an insurance agent, I cannot recommend highly enough to get someone who knows the industry. There are special nuances about beverage alcohol that require industry expertise. There are lots of different types of insurance policies out there. I've listed some of them here. And generally, you will work with one insurance agent who will be able to go to market and find coverage on all of these types of policies for you. So you're not working with 5 or 6 different insurance agents. So moving on to levels of tax. This is a meaty topic because there is a lot here. Let me just pull up the whole slide. Okay. So in the U.S., we have 3 layers of tax. There's federal, state, and local. At the federal level, it's business income tax. And then, of course, we have excise tax as well for alcohol. The federal income tax is going to depend on your entity type. Similarly, at the state level, the business income tax also depends on your entity type. And also, different states have different rules. So if you're doing business in California and New York, there's different expectations from both states. It gets really complex. Likely, there is going to be some level of local tax as well. So municipalities may or may not have tax. And there might be a local payroll tax and not a local income tax, or vice versa. The point is, you need to work with someone who understands all the different jurisdictions so that you're covered, and trying to manage it on your own is just a bad idea because not only are there 50 different states and thousands of municipalities, but this stuff changes all the time. So find a professional who can help guide you through all these scenarios. So within those 3 levels, fed, state, local, there's also other types of taxes aside from income tax. There's payroll tax. Employers are going to pay tax on wages paid, as well as remit the taxes that are withheld from employees' paychecks. Sales and use tax. This is a funny one. So sales tax is a state thing, and whenever you purchase something, you pay tax on the sale. However, if you are in a state that doesn't have sales tax, you're going to get dinged on use tax, which is you buy something in a different state and use it in your state, and you get taxed for the use of the thing. So get you coming and going, and it's complex. Personal property is tax on things like equipment and furniture, basically any kind of tangible property. And that is a local level, a municipal level tax. And finally, personal taxation. So people who are owners, investors of a U.S.-based entity will have income tax associated with the income that is generated in the U.S. And this also applies to your employees working cross-border as well. Now, it's not all doom and gloom because we do have income tax treaties. The U.S. government has tax treaties with numerous different companies. And what does that mean? It means that there's an arrangement between the countries that minimizes the amount of tax that's due on income generated in the U.S. So How much? It depends on the type of treaty, the specific arrangements between the companies, and what type of income does it apply to. So you might have different tax rules for royalty income, passive income such as interest and dividends, service income as well. And it varies country to country. So again, having a professional with expertise in international tax matters is critical there. Repatriation of profits. So repatriation means the ability to send foreign earned profits back to your home country. And that's what we all want to happen anyway. So the types of income that can be repatriated on the top right of the screen. So royalties of the parent company that is paid by the U.S. subsidiary, that's a repatriation of profits. Management service fees. This might be where the foreign parent is charging the U.S. sub X percentage of sales, for example, as a management fee, and that is going to be profits going back to the home country. Interest and dividends as well is another example of profits that are repatriated. So that's how you get the money back to the home country. And one of the keys in this is that transfer pricing policy that I brought up on the first slide. So transfer pricing policy is the playbook that you create, the policy that you create in your organization to determine the pricing between parent and sub or interrelated companies. And dovetailing into that, that is the price charge between related parties. It needs to be at an arm's length at fair value. I'm sure you've heard many news stories of, companies that have operations all across the globe, and then they try to push the profit into the lowest tax jurisdiction. So transfer pricing is a bit of an art and a science, because you want to have an amount that's defensible, that you can substantiate and gives teeth to your policy. At the same time, you want to sort of go right up against the limit of what allows you to have the most favorable outcome. So because it's something that's a bit of an art and a science, I recommend that every business have a defined policy in place. One of the things you can do to give some teeth to that is to pay for a transfer pricing study, which is usually done by an international tax expert. The reason why you would go to this length is because it protects your position. Again, if you were to get, investigated by the IRS, and there was some gray area on whether your pricing was appropriate, having that transfer pricing policy gives teeth to the position so that you have more of a leg to stand on. Otherwise, you run the risk of having some of that profit pushed back into the U.S. or to a higher tax jurisdiction. If you do go it alone and you're not getting an official transfer pricing study done, do at least have a policy that's written down where you're doing substantial legwork to check the fair value of the prices, and it's something that you update on a regular basis. So again, there's no right or wrong way. These are all just things to consider as you're bringing your product to market. So that's about the sum of it. And I hope that I've given an exposure to some of the things to think about. I've probably provided more questions and problems in your head than solutions, but at least you're now more aware of it. So this is my contact information. Please reach out at any time.